For months, global markets have been drowning in anxiety. Tech stocks have been crushed, software companies are facing unprecedented pressure, and a tidal wave of fear is spreading across Wall Street about one thing: AI disruption. Investors are asking whether entire segments of the software industry are about to be wiped out, and with every new headline about automation or collapsing valuations, that fear only grows. But while the public conversations fixate on loss, uncertainty, and risk, there's another story unfolding quietly behind the scenes. A story involving some of the world's largest alternative asset managers, companies handling billions in private credit, real estate, direct lending, and institutional capital. So rather than panicking, these firms are carefully stepping forward to explain why the anxiety may be exaggerated and how their portfolios are much stronger than the headlines suggest. And today, we break down exactly what they're saying and what it means for the future of markets. Over the last year, a strange split has emerged in global finance. On one hand, AI-related companies are exploding in valuation. Chip makers, data center operators, model developers, and automation platforms are experiencing unprecedented demand. But on the other hand, traditional software companies, especially enterprise SaaS firms, are getting hammered. Their stock prices have fallen sharply, layoffs have increased, and investors are openly questioning whether AI will cannibalize their business models. For many software providers, the fear is existential. What triggered this collapse? It wasn't just weak earnings or slowing growth. It was the narrative shift, the idea that artificial intelligence could automate away entire categories of software products. Tools once seen as mission-critical are now seen as vulnerable. Processes that required thousands of knowledge worker hours may soon be handled by AI agents. And subscription models that rely on incremental user growth are being challenged by automation systems that cost a fraction of the price. Naturally, when fear grips one corner of the market, it rarely stays contained. Investors begin to ask whether private credit funds, business development companies, and alternative asset managers, many of which lend to software firms or own software-driven portfolios, were also exposed to the same risks. As sentiment turned negative, the pressure quickly spilled over into the share prices of these asset managers, even when their actual exposure was small. This set the stage for a wave of panic-driven selling, confusion, and volatility, and forced asset managers to go on record to address the issue directly. Alternative asset managers operate in a very different space compared to publicly traded tech companies. They focus on long-term, cash flow-based investments, private credit, corporate lending, infrastructure, real assets, and specialty strategies. Unlike software firms, they're not valued on hype cycles or user growth metrics. They rely on predictable interest, income, diversified portfolios, and institutional capital. So why were their stocks dragged into the storm? Because of association. Software companies rely heavily on loans from private credit providers. Many enterprise platforms were built using debt financing during periods of low interest rates. When investors worry about a wave of software defaults or slowdowns, they assume lenders will be hit next, even if the exposure is small or manageable. Furthermore, in the world of public markets, fear travels faster than logic. When one major sector comes under pressure, algorithms and sentiment models often extend the sell-off to adjacent sectors. This is what happened. Fear spread indiscriminately. Asset managers with minimal software exposure saw billions wiped off their market caps, simply because they were perceived to be connected to the software downturn. And as the headlines intensified, investors began asking a crucial question. That's when executives began speaking. At a recent financial services conference, executives from major alternative asset managers addressed the concerns head-on. Their message was clear. One major asset manager reported that only around 15% of its credit, a portfolio, was connected to enterprise software. And even within that slice, most companies had strong cash flow, stable customers, and low vulnerability to AI disruption. Another firm revealed that its software exposure was only 6%, a negligible share compared to its diversified holdings across industrials, healthcare, and infrastructure. Executives emphasized a few key points. Their portfolios span dozens of industries, meaning a downturn in one sector won't collapse the entire system. Not all software categories are vulnerable. Some are strengthened by AI, not weakened. While public market software stocks may fall, private credit lenders focus on cash flow, collateral, and downside protection. Investors in private credit vehicles are not rushing to pull out money. In fact, some managers report inflows. This kind of transparency is rare in finance, but it shows how seriously the firms are taking this market shift and how determined they are to prevent unnecessary panic. Part of the reason the panic spread so quickly is because the public has a distorted understanding of AI's impact on software. Many assume that if AI can automate a task, then every software company that facilitates that task will collapse. But the reality is much more nuanced. Some software tools are deeply integrated into enterprise operations. They provide compliance, auditing, financial reporting, data access, or workflow automation that is not easily replaced by AI. In these companies, AI becomes a tool for enhancement, not a threat. Others serve industries where human oversight is legally required, even if AI improves. Speed, it cannot replace the product. Executives reminded investors that many software companies generate subscription revenue that is resistant to disruption. AI adoption often strengthens software platforms instead of eliminating them. Companies that integrate AI into their tools can become more competitive, not less. In other words, the assumption that AI destroys all software businesses is an oversimplification, and alternative asset managers, who perform deep due diligence before lending, understand this nuance far better than public sentiment indicators. One surprising theme emerged from the conference. Markets don't always move based on rational analysis or portfolio fundamentals. Sometimes they move based on psychological contagion, panic selling triggered by incomplete narratives. When software stocks crashed, many investors didn't bother examining the actual exposure of credit portfolios. They simply assumed that all asset managers were deeply tied to software risk. This fear alone was enough to drag down valuations. Ironically, the asset managers themselves remained stable. Their portfolios remained diversified. Their underlying borrowers continued to make payments. But market sentiment, driven by headlines rather than data, can create the illusion of crisis even where none exists. Executives warned that if fear becomes irrational, it can create self-fulfilling cycles. Companies with healthy financials may find it harder to raise new capital. Borrowers may delay expansion plans. Investors may remain on the sidelines. That's why communication matters now more than ever. Beyond reassurance, the asset managers offered insight into how they actually evaluate AI risk in their portfolios. Their frameworks include assessing whether AI enhances or replaces a company's products, measuring dependence on manual processes that AI might automate, analyzing customer retention, multi-year contracts, and switching costs, stress testing revenue models under different AI adoption scenarios, reviewing the competitive landscape as AI tools enter the market. This level of analysis isn't something the average retail investor performs, but it's critical. It means alternative asset managers are not blindly exposed to the most vulnerable segments of the software industry. In fact, some firms have been evaluating AI risk since 2024 or 2025, long before the recent panic began. Many already incorporated AI-specific due diligence questions when underwriting loans or assessing equity risk. This proactive approach is one reason executives remain confident. They saw this coming, and and they prepared for it. As the fog of panic begins to clear, a bigger question arises. What does this moment reveal about the private credit industry? It shows that private credit is becoming a stabilizing force in markets. It shows that alternative asset managers are willing to publicly defend their positions when markets turn irrational. And it shows that diversification across industries, geographies, and risk profiles remains one of the strongest shields against technological disruption. In the long term, private credit may emerge stronger from this period. When public markets become volatile, institutional investors often shift toward asset classes with stable cash flow. And private credit fits that description perfectly. Even in a world of rapid AI transformation, companies still need financing, they still need partnership, they still need capital that understands long-term business models rather than quarter-to-quarter earnings pressure. This is where alternative asset managers thrive. The global software panic has revealed many things: the fragility of market sentiment, the speed at which AI narratives can spread, and the difficulty of separating real risk from exaggerated fear. But it has also revealed the resilience of alternative asset managers, firms built on diversification, long-term strategy, and intelligent risk assessment. They're not ignoring IT, they are not dismissing technological disruption, they are simply looking at the data and not panicking. In a world where headlines predict collapse, these firms are offering clarity. They're showing that while AI may reshape industries, not all companies are equally exposed, and not all portfolios are built on shaky ground. Fear spreads fast, but understanding spreads faster when you look closely. In the end, alternative asset managers are reminding the world of a crucial truth. Financial strength is built not on avoiding risk, but on knowing which risks matter and which don't.